um, pricing engine here. Again, expanded. We're going to go 1 year P&L, as most lenders look at a 1 year. We're going to do a 1.5 for now. Okay. And then let's start off with 80. Okay. 765 FICO score. Remember, guys, always select that self-employed borrower. It's a primary residence in Orange County. No housing events. We're good. So we're submitting it. Okay. There it is. And there it is. And you can probably see why I used the lenders that I did for the comparison chart, because you see ARC, you see Mega Capital, you see NewFi. Where's AmWest? Oh, AmWest does not have, well, they do, but the pricing is not good. Yeah, at 80%. Okay, so let me actually show you that. AmWest is going to be somewhere down, here it is, down the list. Okay, you see that? But you'll see the difference at 75% LTV. Okay, 25% down. Okay, and let's just select one. Let's select ARC. Okay, let's go into their product matrix. Right, it was an I button, guys. Right, and let's go to CPA prepared. This one has a nice table of contents. Let's go to page 17. There it is. Okay. So actually, ARC 2 does allow CPAs, EA, CTEX. Okay. Let's see. So if we kind of read through it, it says either ARC CPA letter or a signed letter from the CPA and the firm's letterhead contact information, length of relationship, right? They wanted to see the length of relationship. A letter from the bar confirming intent to use CPA to file. Okay, this is when they switch tax preparers. Okay, so look at this one right here. So if your CPA now, the borrower CPA says that they had just a 1 year relationship, right? Then they may ask for additional and didn't file the tax returns, or because it's less than 1 year, they may ask for additional documentation. So this year, your takeaway is if you're using ARC, you don't want that CPA to say 1 year or 5 month or a new relationship. You probably want the CPA. The CPA is going to have a multiple year relationship, not to go into additional information. Okay. Any questions there? Okay, here's information regarding bank statements. Option 1, no bank statements. In addition, pricing hit applies and must reflect that the product CPA without bank statements. Okay. On the ARC's CPA relationship letters, CPA USS test as the audit option to 2 months bank statements. So, okay. So if you don't have bank statements to support the P&L, you're going to get another pricing hit. Okay. So again, so important to go into these matrices. They're not that long. It's 26 pages. Half of them you're going to skim through anyways. But it's so important to look through the guidelines, guys. Okay. But for the purpose of today's call, yeah, go ahead.
Could you go back to the 2 month bank statement section and the 10% tolerance and kind of dive deeper a little bit?
So did I miss it? 17, right? It was around 17. Here it is.
It was at the bottom of this page.
There it is.
It's basically saying that if the 2 months bank statements provided do not meet that 10% tolerance, they may continue to adjust bank statement.
Yeah. At which point you do want to probably just go with a no bank statement program, right?
Right.
Yeah.
We have to know that ahead of time.
Correct.
So one note, if you do the hit with no bank statement option, they will be the same as Mega or NMSI pricing. So when we have, let's say, bank statement product, and we ended up collecting 12 months bank statements and find out that first 6-7 months are really weak, but the most recent 2025 income is really high, really strong, then instead of encouraging them stretching with bank statement loan, explaining why 2024 income was low, we can intentionally shift it over to a P&L product that has a better pricing with ARC or Carrington or AM West. Because P&L product with specific lenders only have one type, like New Wave or NMSI. They don't offer both options. Whereas the investor levels, like ARC Home or Mega or Carrington, who takes maybe 1.5 to 2 weeks for the approval, especially with Plaza Home Mortgage, their pricing is exceptional, phenomenal when you have 12 or more months of reserves. So I don't want you to just understand one topic. Understanding one topic allows you to compare multiple different loan options. But what I want to do is start with the 24 months of reserves and going down to 6 months of reserves and find out whom approves and whom doesn't. So Ragnar, if you can click the ineligible product tab, with the same scenario, you'll be able to see why the other company is denying the loan. So if you understand these reasons why and be able to catch it, then you will be able to make another 100 basis point, depending on which product to pick when you submit the loan.
Yeah. I just want to elaborate on something that Peter just said, guys. I'll get to that at the end. So I don't know if you saw this, but I changed it to 75. When AmWest was on the bottom, now it's near at the very top. Okay, at 25% down payment. Okay, so again, but you still have Mega there, ARC there, yeah, New Res is there. You obviously have NewFi is still up there. Okay, at 99.5. But right, depending on your down payment, obviously you will see your pricing change. Now I'm going to do one more thing here as I conclude. I'm going to just quickly, guys, change this to a bank statement 12-month program, and we'll see. Keep in mind the rates were what? 6.75. Okay, so bank statements are going to be 6.625. That's about an eighth. Okay, there again, for right now in the season, it seems like the bank statements are an eighth better, but there are moments, throughout, or it's seasonally, things are different in the non-QM world. You will see the pricing this exact same. Okay, but again, AmWest being at the top right now, still have Mega. You got your usual players. Now, let me just change this to 80 bank statement, and we'll see. Okay, there it is. So at 80%, okay, bank statement and P&L program, the rates are the same at 80%. Okay, so now with this said, I do want to address, elaborate on what Peter just said, guys. Simply put, as a loan officer, guys, okay, you are not thinking right away. I don't think this is the right approach. Okay, you shouldn't just think, oh, I'm gonna get this person in a DSCR program or in a bank statement program or whatever other program. You can tell that to yourself. That's fine. But that's not the message you're relaying to your client necessarily. Your job is to be a mortgage loan officer. It doesn't mean that you are a conventional loan officer or a FHA loan officer or a bank statement loan officer. It's Actually, it's all of the above. And so one thing that I've learned, okay, through working with GivingTree, this is a mindset I have adopted working here at GivingTree, is obviously I came with experience, but you're coming in consulting your client, okay? But the key thing is you're consulting through the client, right? And so you're not discriminating any product right now. You're trying to gather as much information as you can. That 1003 supporting documentation, yes, bank statements. Maybe you don't have to collect 12 months bank statements up front, but usually you are collecting 2 months up front, right? And business and personal, by the way, regardless of the program. And there, once you receive the program or you have that conversation of, all the pieces that the borrower entails, that's when you're starting to narrow down what programs might work better for them. Okay, so when you have all their information, after you review everything, then you can start kind of narrowing down what might be the benefit to them. Okay, that is something that I've learned the past year or so here. Don't just think that the bank right off the bat, the bank statement is going to be the best product for them rate-wise or otherwise, because unless you really, really know the matrix in and out, okay? Because there might be an alternative that actually might work better for them. Okay, so I'll give you a quick example. Like that client that I just did a credit rescore on, I could have just easily done a DSCR program for them and actually got them a better rate, okay? But the reason why I didn't do that was because later she tells me she's expecting additional funds from the passing of her grandfather. And so she only really needs a loan for about a year or two. But if I went with the DSCR, one, we have to say it's an investment home, but two, there's also prepayment penalty, right? So if we to remove the 5 year prepaid, the rate was going to be nearly just as high, okay? And they're going to have to go through the whole, hey, I have to convert this into an investment property and so on and so forth. So again, just quickly trying to narrow down a product right off the top because the general, how a program generally works, I wouldn't say is the wisest thing to do. Okay, that's just my 2 cents there. But do you guys have any questions regarding the P&L product? Any questions? You guys generally kind of, for the most part, have a better understanding of how it works. In contrast to the bank statement program. Okay.